All right. Okay. So let's quickly recap some of the important points we covered yesterday. While discussing this point number 9, which is on the distinction between, we have to make this much smaller. Now, guys, on the last bench, Satyam, can you read this?
No, sir.
You can't read it? Okay. So then we'll have to just make it bigger, and then we can't see both the columns together. Now, can you read?
Better.
Better. One more. This last. Asset class specific indices as long only benchmarks. Can you read this on the last bench? Okay, fine. So we just have to live with the fact that we can't. And anyway, most of the stuff on the right hand column, in the right hand column, is the opposite of what's on the left. Okay, so we've covered most of these points. Yesterday we had spoken specifically on this point, which is active versus passive management. Okay, I don't know how we got into that discussion, but anyway, we kind of skipped over to point number 9. So the point is that the question that Tushar asked, and in response to that, we were discussing that in the context of the shift, big trend that is happening in money management, okay, which is that there's a seismic shift of capital from active management programs to passive management programs. It's really driven by 3 things. One is that the underperformance of active managers, which has persisted for many years, okay, and then if we go back here, one minute, let me just. What do you think? If I shut this thing down, will it stop the recording? It's a player. Why should it stop the recording? Yeah, if I minimize, it should no longer be an active window. But when I'm toggling through windows, I think I'm just going to take a chance and shut it. And it does not affect the recording. There's some kind of bug. I don't know why it's launching that player. Okay. All right, guys. So in this on this point number 9, I'll just where did we discuss that shift of so let me just put it into point number 9. I'll just write down the point so that you have a chance to because we haven't yet come to point number 9 actually. This, okay, so active, the shift of capital. So for this trend we have 3 factors which we should just write down so that you should know this. Underperformance relative to benchmark, okay, underperformance of active managers. I'm going to use short forms, okay. So active managers, underperformance of active managers relative to benchmark. Then higher fees of active managers. All right. So the logic is that if I'm paying you higher fees and you're underperforming relative to the benchmark, which is usually a passive equity, which is an equity index, okay. So then the investors are going to say, why should I pay you more for to get less performance? I might as well directly invest in the equity index through a passive program and pay much lower fees. You got the logic? Okay, we're going kind of basic. We're going through the logic once again, but I want to make sure because very often we find that during the exams, the kind of answers we're getting, it shows that people haven't really understood. Okay, so make sure you understand every step of the logic. So higher fees of active managers, underperformance of active managers relative, and of course, I mean, let's put it this way, relatively higher fees, okay. So obviously then the lower fees of passive managers, I'm not going to mention that as a separate point because it's related to this point, which is active managers have higher fees and they're underperforming relative to the benchmark, and passive management basically involves investing in a benchmark. Okay, when you look at this is one of the good examples of passive management. If you look at this most actively traded ETF in the world, the SPY, which is essentially a ETF that tracks the S&P 500 index. Okay, those gaps that you're seeing is because the market is opening at different levels from the previous close. That's why you see the gaps on the chart. Okay, and this thing, the charts are made only for regular trading hours. It does not cover the performance over the I mean the what is called outside regular trading hours. Okay, so this is your S&P 500. This is actually, it mimics the movement of the S&P 500 index. This is SPY, the actively traded ETF. So instead of paying managers extra fees to underperform relative to this benchmark, which is the most common equity benchmark from equity mutual funds, for actively managed equity mutual funds, you might as well pay much lower fees, invest in a passive fund, just go buy this ETF. That's passive management, because this ETF is mimicking the S&P 500. Okay, so therefore it's much cheaper to do this. So therefore people are saying, why should I bother to pay you extra money? That's one. Second is that the other important point, which is the more complex point, which we discussed, okay, which is that the monetary policy response to the GFC, which we discussed in detail yesterday, this has led to basically a drop in correlation between assets. Let's call it between markets. Okay. So the drop in correlation has happened. This is the more important point which I discussed yesterday, which may be a little complicated, which is that, so obviously what you have is, you understood the monetary policy response which we discussed yesterday to the GFC. First aggressively cut interest rates, and then you see that nothing is happening. Growth is not picking up even though rates have been cut so aggressively. Then what you start doing is you start doing quantitative easing, which means the central bank goes into the market and buys bonds outright. Okay, government bonds, then government guaranteed kind of semi-government entities like Fannie Mae, Freddie Mac, or mortgage-backed securities, okay, mortgage-backed bonds. Those bonds, so government goes and the Federal Reserve goes and buys all this kind of stuff. So obviously when they are buying bonds, they are selling what? Currency. Okay, so they are buying bonds and they are selling US dollars, and so the money supply in the system is increasing. So they are flooding the system with money, essentially to encourage people, encouraging the banks to lend, and creating an atmosphere like, don't worry, you know, it's like, don't worry, it's like kind of pampering a child. Don't worry, we are going to be there with excess liquidity in case of any credit crunch. So go ahead and take risk, essentially encouraging people to take risk. So as a result of this, what happened was, because the system was so flush with liquidity that everybody started piling into risk assets. And essentially, this is the important subtle point, that normally when you look at the normally when you look at the drivers of risk assets, okay, if you look at something like yesterday we discussed Tesla, okay, we can look at this. It remains a very interesting stock. So if you look at a Tesla, you'll see why is it an interesting stock, because they have a bond payment coming up in March. There is some cash flow issues. You know, they recently announced a big layoff, a bunch of 7,000 people. They're laying off because they're trying to cut costs, trying to move down they want to sell slightly cheaper cars, okay, so they can have more volume. So all these things. So if you look at Tesla, if you look at the equity analyst community's views on Tesla, there's a very big divergence. There's a very big split, okay. A lot of people are saying this company is a disaster, and about 50% are saying this company is the company of the future and all that. So a lot of the point I'm trying to emphasize is that you agree that this is a risk asset? Common stock of Tesla is a risk asset. Okay, so normally when you look at any risk asset, there's a whole bunch of different factors that are driving the returns on risk assets. So here you have what's going to happen to battery technology, how well will BMW and Porsche and all these players, how well will they come into the electric car segment. So there are all kinds of other dynamics that are driving, all kinds of varied dynamics that are driving the price of risk assets. You understand what I'm saying? In a normal situation, there's technological uncertainty, competitive behavior, okay, all kinds of general economic growth, etc., consumer sentiment, all these factors. But what is happening is, because the central banks flooded the system with liquidity, okay, so aggressively, that the excess liquidity became the sole driver of everything, because everything was going up. Okay, people were just piling into risk assets without regard to any kind of other factors, because they had a sort of carte blanche from the central bank saying that, you know, go ahead and buy, take risk. So the excess liquidity started driving all risk assets up together. So as a result of that, what happened is that the correlation between assets collapsed. I mean, I wrote it wrong. What I meant was, it should not be drop in correlation. It should be the opposite. Okay. Rise in correlation between markets. Okay. Markets, assets, same thing. Okay, because you're trading the base asset in any market. So what happens is, because one single factor, liquidity, is driving all assets, as it becomes the dominant factor driving all asset prices. So what happens is that differential, normally if you're looking at copper will have different factors driving it, than lead, then aluminium, then iron ore, coal, there are different dynamics. But if what is happening is if one single factor is driving, has become the dominant force in all markets, then all markets start moving together. Okay, so therefore what happens is, especially in the traditional asset classes like stocks and bonds, all stocks started going up. Okay, so what happens is here the relative performance of active managers becomes much more difficult for active managers to stand out. Do you understand why? Like yesterday I gave you an example. How do active managers outperform? They do stock research. Okay, so they would look at all the streaming companies and they would take a view that okay, Netflix is their strategy is much better. They are going to do much better than other companies like Hulu, and they're going to take away share from a lot of media companies like Time Warner and all these other companies. So therefore there has to be some kind of, first of all, some stocks have to behave differently from other stocks. Okay, and then you have to be right to catch those big winners like Netflix and Facebook and those kind of companies. Like the classic example is if you look at Facebook versus Twitter. Okay, if you look at Facebook first. So Facebook has suffered a lot recently, but if you let's look at weekly charts and see. All right, and then if we compare this to okay, so you can see the difference in performance that Facebook in that same period, okay, obviously starting from here where the data series, because the Twitter IPO came later. All right, so here you can see that Facebook is up about 285% and Twitter is down about 20%. Okay, so but there are lots of VCs who also invested in Twitter. When they started out, then let's say in 2014, nobody knew that there was going to be such a big difference in their performance. Okay, so this is how active managers make money, that they are able to select particular stocks. Okay, they're able to select particular stocks which are going to do well and sell stocks which are not doing well or avoid those stocks. So the point is, if all risk assets are going up together, okay, if all stocks are going up together because of excess liquidity, it becomes much harder for active managers to outperform because everything is going up. So there's no special treatment given to people, no special rewards are given to people who are able to select better stocks. Are you able to see what I'm saying? When you guys go out, please make sure you shut the door properly. Are you able to see what I'm saying?
Yes.
Okay, it's not a very convincing yes, but maybe you can think of.
Yes, sir.
Okay, good. I'm glad you've woken up. Okay, so all right. So anyway, so think about this. So these are all factors, and you need to be aware of this trend. I just wanted to we're not going to spend more time on this because we've already recorded all this stuff. Okay, so this is basically the point of what is going on, and this is these are the factors driving this. You need to be aware of this trend, which is the shift of AUM from active to passive management. All right.
So there is rising correlation between markets and index.
Yeah, well, the markets, if you see, the markets and index are not really kind of independent, because what is an index? S&P 500 is a average of 500 stocks.
Yes, sir.
Okay, it's a weighted average of 500 stocks. So in some sense, there is, whenever you're tracking any of the stocks, individual stocks against which happen to be in the S&P 500 also,
Yes, sir.
there is some element of double counting, because that stock is also inside the average,
Inside, yeah.
right? So the market index is actually just nothing but an average of the stocks. Okay. So what was your question,
The market is
basically?
correlated with the index. Exactly.
Yeah, everything tends to go up, so that will also happen. That if the overall index is also going up, and individual stocks tend to coalesce more closely to the overall index performance. Okay. So therefore, basically everything goes up. So it becomes difficult for people who are who are more discerning as active managers to outshine the passive management, programs. Okay, guys, let's move quickly we need to finish this topic so we can move on, because we have another project to deal with in this semester. Okay, so we've covered all the points. Okay, all these points we've already discussed, and okay, I just want to add one more point about the high water mark. So remember that when we go back to point number 7 on the distinction between TAM and AM, so what is how would you roughly summarize the difference in compensation?
Incentive fees.
Correct. Okay, so if you want to just quickly understand the difference between compensation in AM and TAM, okay, that in TAM there is no incentive fee. There is only a management fee, which shows up as the expense ratio of the mutual fund. Okay, and in AM there is a management fee plus an incentive fee. But you need to be aware that some managers, in order to distinguish themselves, like I mentioned, Tudor Investments, okay, they did not charge management fees.
Only incentive.
Yeah, only incentive fees. In which case, the incentive fees some of the incentive fees are much higher than 20%. Like there was this guy called Steve Cohen, who is one of the top equity traders. So he had this fund called SAC Capital. So they used to charge, I think, 30% of excess profit, and he also, I think, didn't have a management fee. So he would charge 30% of profits, where the industry standard is 20% of profits. Okay, he would charge 30% of profits, but he made a lot of good money for investors, so people were still willing to invest with him. Okay, so that firm has now become known as Point 72 Asset Management. They have an office in Singapore as well. So if you come across Point 72 Asset Management, that is nothing but Steve Cohen's firm, which earlier used to be called SAC Capital. Okay, so they were shut down because of some regulatory problems. Some of the guys were involved in insider trading and things like that. So okay, so we've covered most of the points. So I just wanted to spend a little bit of time on compensation. Where is compensation? Okay, so here there's no incentive fee. And just one point to understand, this point that I put in here, that the incentive fee is only paid for profits above a high water mark. Have you heard this term before? High water mark?
You told us.
High water mark, use your common sense. If you're sailing or something like that, if you're involved in something to do with the sea.
Sir, benchmark, we can say high water mark can be termed as a benchmark. For example, if they have set a benchmark of 20%, so if the profit is more than 20%, then only they will get this incentive fee.
Yeah, but there is a difference between the high water mark and the benchmark. I'll come to that. So what you're mentioning is, that what you're actually describing is a benchmark. Okay, let me just go back to the SPY chart to understand what a high water mark is. High water mark is simple. Use your common sense. If you're a sailor, what is a high water mark? When you're looking at the shoreline, you can see the water line. Even when the tide has gone down, you can see from the water marks on the, let's say on the pier or whatever, you can see from the water marks what was the previous highest level of the water when we had high tide.
Yes.
Previous high.
Yes.
That's a high water mark. Okay, you can see that on the pier. Okay, so that's what it is. Okay, so let's see here. Let me just, why is this weekly? Okay, we should have more data here. I want to capture the 2009 decline. Okay. All right, so this is your S&P 500 being proxied by the SPY ETF. All right, so this is, you guys should have a sense of economic history also, important historical events. All of you guys should be aware of the internet bubble, which happened in like the second half of the 90s to 2000, peaking in 2000. This is the internet bubble, okay? And then you had the decline from the internet bubble, and this is again the housing bubble, or you can call it the mortgage, the residential mortgage-backed securities bubble, okay? So the housing bubble, essentially, that was the underlying asset, and then the bonds were created, the mortgage-backed securities. So this is the crisis. September 2008, Lehman Brothers goes bankrupt. So this is the bursting of the housing bubble. All right. Okay. So this high is actually slightly higher than the internet bubble high. All right. So now imagine that this is not the SPY. This is somebody's fund performance. So we're trying to understand what is a high water mark. Okay. Because remember, the incentive fee is paid as 20% of profits. Okay. So whatever you make, you get 20% if you're a standard alternative asset manager. So now let's imagine that this is actually the plot of the guy's total asset value. You start out, let's say this is zero. We start out with zero. We start out with $45. Okay, and then you start making money, and you go up to here, which is you made about $156, $57. Okay, so every quarter the money gets paid out. So from here to 45 to 157 or 158, you've made all this much money. So you've earned the 20% of profits of the difference between 158 and 45. Is everyone following?
Yes.
Okay. What, any dissenting voice? I thought I heard somebody. Okay. Anyway, so now please don't be worried about dissenting. So what I want is more people should actually complain when they haven't understood. Because, okay, so now the fund performance starts to decline. Okay, now we are here, we've reached a low of 73. So after having made 158, raised the asset value, fund value to 158, the net asset value of the fund has gone to 158, and then it starts losing money, and then the fund comes down to 75, let's say. Okay, and then it starts to recover again. So now the question is, suppose this has happened in 1 quarter. It has gone from 75 to 115. Now should this guy get 20% of the profits between 115 and 75? Akanksha is very confident she would not going to pay him. Why?
So it is below the high water.
Correct. So this is below the high water mark. He's already earned this. So the point is that the incentive fee so when you're discussing this entire topic of alternative asset management versus traditional asset management, okay, when you're looking at the difference in the compensation structure between AM and TAM, one of the things is the incentive fee, okay, is what is not present in TAM. But then how does the incentive fee get paid in AM? That also you should be clear about, and that is the profits, only 20% of profits above the high water mark. Okay, so you need to make fresh money because you already, think of the logic of this. You've already earned 20% of the profits from here to here. Okay, so you can't be paid now for recovering from 75 to 115. Okay, that would be double counting your profits. Okay,
if he does not reach at that point again, then what will be?
Then life is too bad. You got to shut down. That is one of the reasons why you'll notice that after a big decline in the market, okay, and many times we see a lot of correlation between markets, even today or sporadically that happens. If there's a big decline, like you notice this fall in the stock market, the oil price decline also is kind of more or less, similar. I mean, it happened at the same time. Okay, there was a sharp decline in the oil price. Remember, after Trump decided to give exemptions to the Iran, because the price of oil had been bid up because of the fear of Iran sanctions in November 2018, and then suddenly he decided to give a lot of sanctions relief to India and some other countries, China.
6 months.
Japan, China. So suddenly then the market realized that there isn't actually going to be a supply shortage, and then there was a dramatic collapse in the oil price. Okay, so that kind of stuff, I think it was kind of more or less slightly off, but it is more or less at the same time, you could say. Okay, so now what's happening here is, sorry, what was the topic I was discussing? I was responding to that point that what will happen, what Tanuj is saying, that what happens then if you don't earn your incentive fee. So you will notice when there's a sharp fall in a lot of markets, okay, like oil and a lot of hedge funds lose money, and then you'll find in the immediate aftermath of that kind of dramatic fall in the markets, a lot of hedge funds will close. Why? Because they close because they can't afford, they're not earning the incentive fee, and they have high overheads, and they can't afford to pay their staff. Okay, so they have a lot of analysts and a lot of IT people, etc., compliance people. Running a hedge fund is quite a complicated business because there's a lot of compliance burden as well nowadays. So there's a big there's pretty high overheads. Everybody understands what overheads is? Yes. Okay. What is overhead? Solanki? Banker. What is overhead?
Overhead, human costs.
Yeah, but what kind of costs?
Those cannot be classified.
Well, let him answer, no? Banker. He's going to be analyzing balance sheets very soon. See? Okay, please go ahead, revise. I'm not going to spend class time deciding. You please learn from your friends and revise, okay? Okay, so the point is basically they have a lot of fixed costs, okay, which they're going to have to incur whether they are doing any business or not. Okay, whether there's any selling going on, production going on, there are some fixed costs which have to be incurred. So they have paid salaries to these analysts and IT people, compliance people. Okay, so all these fixed costs. So these guys have to shut down. So you'll notice that a lot of hedge funds will shut down after there's a market collapse because they are so far down. The funds are so far down. They're kind of like here. Okay, they're kind of like here, and they know that they're going to take a long time to recover to this level. Remember, this is the fund's P&L we are looking at. Okay, so they're going to take a long time, and these guys, what they see is that it's not going to be possible for us to recover the fund, take the fund back to those levels, and we have such high overheads, we better close down the fund. Okay, so you'll see a lot of hedge funds closing in the aftermath of sharp market declines.
So what happened to the leftover money when the fund closes?
You return the money to investors. Okay, so all right. So leftover money means obviously from here only. This is only what you can return. This has already been lost. You can't return this because you've already lost from here to here. So here you just dissolve the fund and return the money. Okay.
Sir, we can go either up or down in AM. So we can take the highest low and lowest lows as the.
No, I didn't get what you're saying. Use the mic, since we've taken the trouble to use the mic so that it gets recorded. Yes, I can hear some murmuring going on. Please don't talk and yeah, go ahead.
In AM we can go anywhere. We can even buy the shares or sell the. We can buy the asset or sell the asset.
Yes.
So we can take highest watermark as the lowest low.
No. Let's be clear about one thing, okay? This thing which I'm showing you now, although it's actually the chart of the SPY ETF, I have pretended that this is not the chart. This is actually a fund's NAV.
Okay.
Okay, I have forced you to assume that this is the NAV of a fund. Okay, so this is your fund performance. So this performance may have been achieved by shorting stocks or by buying stocks.
Yes.
If you are an alternative asset manager, you are allowed to short stocks as well.
Yes, sir.
There are many funds which are. Did I tell you about somebody who is a dedicated short seller? Let's test your memory. I asked you to follow 3 people in the market.
Jim Chanos.
Good, very good. At least I'm impressed that at least some people remember this stuff. Okay, so Jim Chanos, who runs Kynikos Asset Management, who famously shorted Enron. Okay, he knew about the problems in Enron. Okay, he sort of cottoned on before the market realized it, and he went short Enron. Okay, so he runs Kynikos Asset. He's a dedicated short seller. So this could also be the Kynikos NAV.
Yes, sir.
So when it's going up, it's not going up because they're buying stocks, because it's the NAV of the fund. It's going up because they're selling stocks at $100 and maybe buying them back at $70.
Yes, sir.
All right. So have you understood? Does that answer your question?
No, sir.
Okay. What's your question or what's your point?
My question is that so it does not depend on the NAV of the firm. So alternative asset management, we can go either down or we can go either up. So
No.
the lowest low
One second. Let me understand what you mean by going down. Or do you mean that you can either go long the asset or short the base asset?
Yes,
Is
sir.
that what you're saying?
Yes, sir.
Okay. So don't say down or up. Say we are allowed to go either long or short the market.
Yes,
Yeah. Yeah. Not using proper terminology. Very correct. Gaba is the class monitor. Okay. Yeah.
So we can either go long or
Okay, guys. Let's not have all this murmuring in the background when he's talking. Yes.
we can either go long or we can go short.
Yes.
So sir, if we go short, then also we are making the profits.
Why is there some noise coming? I can hear a female voice somewhere murmuring. Okay. All right. Yes.
So when we are going
I've kind of lost. It's very disturbing because I've lost. So you're saying that yes, we can go either long or short.
Yes, sir.
Okay. Yeah.
So then the lowest low should also be the incentive price, highest watermark for the incentive price.
You're saying something like this. This one. This one somewhere here.
Yes, sir.
And somewhere here.
No. So can we mark that as the first lowest?
Which one? This one.
This one, sir.
This one.
Yes, sir.
Okay. This is the L1.
L1.
Then this is
Then
L2.
is lower than L1.
L2 is lower than L1.
So
Yes.
this should also be the highest watermark. L1 should be the highest watermark, and if the person goes below L1,
No. Okay. 1 minute. Let me just explain. You have not understood high water mark. Okay. Who's talking here? Is it Bhatia? Okay. I can hear some female voice constantly talking. Okay. You have not understood high water mark.
So high water mark is basically the.
No. First. No. You use it. Use the mic when you're talking.
So what I understood that the high water mark is basically the highest point that the hedge fund is making from that investment.
Yeah, but the language is not correct. Talk in terms of NAV. You guys understand NAV now? NAV is the same thing that IB calls an NLV in its account statement. Net liquidation value, that's also the net asset value of the fund. Okay? The mutual fund language is NAV, and even in other funds, even in AM, this language is used. So use the mic. So let me first explain before you ask your question. So let this be the plot. Imagine that this is the plot of the NAV of the fund.
yes, sir.
So when you start with $100 and you make when you made an absolute profit of $15,
Yes.
okay, assuming no brokerage and fees have not been charged, now the NAV of the fund is $115. Is this clear? So this is the plot of the NAV of the fund. So when it's going down, it's because the fund is losing money. It may be losing money on short trades or long trades. So does that now clarify your doubt?
Sir, but he's right. If the fund is going short, the company is making money.
How do you know?
We can take the lowest point of that.
1 minute. Let's not confuse this. This chart, now I'm forcing you to believe that this chart is the plot of the NAV of the fund.
So we got that, sir.
You got that, right?
Yes, sir.
So now, what? If you are, how are you making the statement that if we are going short, we are making money? There's no guarantee that you'll make money every time you go short. Are you? 1 minute. Let me just pin him down. Do you realize? No. Let's come back to your statement. You made a statement that the fund is making money because it's going short.
Yes.
Is there any guarantee that you'll make money just because you went short?
It can be actually.
Sir,
You might make money or you might not make money, right? So why did you make the statement that the fund is making money because it's going short?
May make money.
May make money, yeah. May is fine, yeah. So what is the problem? I'm not able to follow now.
That's right.
No, 1 sec. Tanuj, are you clear about the NAV? About the high water mark? Is everyone else clear about high water mark? Have you understood, Lakshay? Have you understood high water mark? Imagine this is just.
examples when the person will get the incentive fees, sir.
So I'll give you the example, 1 minute, okay? So even here, okay, 1 sec, just imagine this chart. I know for a fact that this particular high is higher, slightly higher than this high.
Yes, sir.
Okay? So when you fall, so all the way from here to here, you've made money, you've enjoyed the entire difference between, say, whatever that, 158 minus 45 into 20%, okay? You got that. Now the fund starts declining, okay? When it starts to recover again, you are making your 2% management fee because that fee is being paid for a different reason. That's not a performance fee. That's a management fee to compensate the manager for the effort he's putting in, exercising his brain, and trying to select the right stock to buy or sell. Okay, so for that effort, he's being paid the 2% management fee. That's why the management fee. Now the incentive fee, I'm coming to that. 1 sec. Let me just finish. Suppose now it goes to, let's say, 160 or let's say 161 for the sake of argument. Now you go to 161. Okay, if you have a quarter in which 161 is the high, you make 161. Now you will get the difference between 161 and 158, which is the previous high water mark. Yeah, so you'll get that difference into 20%. You'll get 20% of the excess profits. Is this clear? Okay, now everyone is clear about high water mark?
Yes.
Which is logical because you get money, you get paid only, you don't get paid twice for making the same return.
Yes. So
Because you're just recovering.
So that means this is always done in one single. So when the person buys,
You're not using the mic properly. That also has to be learned. The mic voice should be coming through the mic.
So now it's fine.
Yeah.
So this is first outright position. Where the manager is not making a long position again and again after an interval of time.
Manager could be doing all kinds of things. He could be taking spread positions, unwinding spread positions, because you can make money even on spread positions. You can make money on repos, which we discussed yesterday. Repos are a spread position. When you do a repo, what you have is a spread position. Remember, because, so repo, we decided we'll call it repo because globally it's called repos in the major financial centers, okay? So remember this, please make sure you understand this, that when you have a repo position, when you've done a bond repo, you do not have an outright position in the bond. Can you see the logic for that? Because what have you done? If you're, let's say, a dealer, Morgan Stanley, you have sold you have done a repo with the US Federal Reserve, okay? In the first leg of the repo, you have sold the bond to the New York Fed.
Yes, sir.
But you have also agreed that you are going to buy back the bond after 14 days.
Yes, sir.
So do you have a net position, outright position in the bond?
No, sir.
Because you have a short on the first leg and you have a long on the back leg.
Yes, sir.
So you don't have a net position. And the amount of the bonds, the quantity of bonds is the same. It's just that the price on the back leg is higher.
Yes.
Because to pay the interest to the central bank. Okay, are you following? So, okay, so you have to recall your definition of spread position. Remember we discussed spread positions? Huh? Yeah, not just, we discussed it in the context of hedging, but spread positions can arise anywhere. Okay, where you don't have an outright position. Remember, did we not discuss that the spread position can be or maybe we didn't discuss the entire definition of spread position. Spread position can be same, we did discuss it, intermarket, this is what? So the repo is what kind of spread, intra-market or inter?
Intra.
Is everyone clear?
Yes, sir.
Himani? Repo is what kind of spread, intra-market or intermarket? 1 minute, let me hear what she's saying. INTRA. Yes, TRA or TER? TRA, okay, alright. So is everyone clear? Kalra, you're clear? Repo is an intra-market spread? Your nodding is not convincing. Okay, make sure you understand this, okay? So going back, so we did discuss, when we discussed spread positions, when we defined spread positions versus outright positions, we did define spread positions comprehensively, and we said that if you have the same position, long or short, long and short, long here, short there, or short here, long there, at different points of time in the same market, that's an intra-market spread.
Like oil.
Yeah, you can do long oil for December and short oil for February next year, okay? So now does everybody understand that a repo transaction is an intra-market spread?
Yes, sir.
Everyone is clear?
Yes.
Because you're in the same market, okay, US Treasury bonds, let's say, 30-year US Treasury bonds, you have sold in the first leg, you have bought back in the second leg. So you do not have an outright position, you have a spread position. And in particular, this is the intra-market spread. Everyone is clear?
Yes.
Okay. So, why did we get into this discussion? We were discussing high water marks.
Incentive fees.
Yeah, so I was saying that, 1 minute. Okay, guys, please. You could have made, this is just a plot of the total value of your fund.
Yes.
Every time you make money, the total value goes up.
Yes.
Every time you lose money, the total value goes down. Okay, this is the cumulative balance of your fund. That is being plotted as a time series. This is a time series plot or a cross-sectional data plot? Time series. Okay, so this is a time series plot of the value NAV of your fund.
This is NAV of my portfolio.
You can call it your portfolio. Okay, good. Okay, good. Tanuj, are you also clear? Okay, good. So high water mark, has everybody understood now? Okay. So we took a lot of time to understand, to cover this point, but that's the whole point of having a class and coming to the class, okay? So make sure you ask good. Sheila got another question. So it doesn't matter if we are able to cover only maybe 30 or 40% of what we plan to cover. But the point is that whatever we have covered in the class, that should be totally drilled into your brain for your lifetime. You should never forget it, okay? Alright, yes, Mansi.
So if we are keeping, for example, in the next quarter.
Okay, B. While she's talking, I don't want to hear any noise. Yeah.
So if we are talking that in the next quarter he has made a similar difference or no difference in the previous high. For example, it was 158 earlier.
Yeah.
And today also after 3 months or 1 year it is 158 only.
Yeah. Okay.
So he is maintaining that position. And
Yeah.
that, so he should get, why should we take only the difference of the profits? He is maintaining the portfolio, the person who is investing is also getting the return.
No, what are you saying? That are you saying that let's say in quarter one, the NAV was 158,
Yeah.
and quarter two also NAV is 158. So you're saying that he should
equal
still.
and above and or over and above. Is it if it is equal, then also he's getting the income?
No, then you tell me. You tell me how you want to pay. Then based on that, I'll decide to manage your money. Okay. Will you? If the quarter one NAV is 158 and the quarter two NAV is also 158, will you pay me an incentive fee for quarter two?
No, sir. No, sir. No growth. 3 minus
There is no growth.
There is no profit. So incentive profit is for incentive fee is for extra profits that you made, incremental profits. Is this clear? Okay, good. Yes. So let's have that. Let's have more people. Any kind of doubt, please ask questions and clarify. It doesn't matter if it slows us down, because the whole point of having a class is to clarify doubts in real time. Okay. Otherwise, because what we are seeing is a lot of material has been covered, and the retention is very, very poor. In your batch, I think the retention is even worse than your seniors. Is what I'm seeing overall. Okay, so please make sure you understand. Otherwise, what's the point of spending all this time and money going through this program? You could have used your life in you could have used your time better. Maybe gone to Haridwar and meditated or something. Okay, all right. So, okay, so what were we discussing?
What high water?
Right, high water mark. Okay, so on the point number 7, the seventh point of distinction, compensation, no incentive fee in TAM, and how is the incentive fee paid in AM? You have to be aware that you get the incentive fee. Incentive fee is only for profits above a high water mark. Okay. All right. Okay. So only one point left to discuss in this particular subtopic of TAM versus AM, which is the dominant forecasting paradigm. Have you guys heard of the word? No, the markets, the standard is 22 and 20. Okay, just like in the market, in the real estate market, if you rent a house, probably if it's a 1 year, you're renting for 1 year, you have to pay the broker 1%, 1 month's rent as brokerage. Now you may negotiate with your broker and make it 15 days, that's different. But the standard is 1 month's rent. Okay, so similarly here, the industry standard is 2 and 20. But as I said, many well-known funds like SSE Capital used to charge 30%. Okay, and maybe even Oak Tree charges higher because they have a hurdle rate. I don't know what their cut of what is the percentage their investment fee is, what percentage. Okay, but the general industry standard is 2 and 20. So I've taken 20 as an example. Is this clear?
Yes, sir.
Tanuj?
Yes, sir.
Okay. All right. So the point number 8, that is the distinction, is, have you guys heard this word paradigm?
It's a paradox.
Paradigm is a paradox.
Paradise.
Okay. Now he's already dreaming of paradise. Okay. You are already dreaming of paradise. Okay. You should wait a little bit. Okay. Now, paradigm, so nobody knows what paradigm is. Paradigm is a worldview, okay? It's a way of looking at the world. You can say socialism is a kind of paradigm. Capitalism is a certain type of paradigm. It's a comprehensive, think of it as a comprehensive, you can look up the dictionary meaning also, but I'll just give you the general meaning of it. Paradigm is it's a comprehensive system for, a governing or way of looking at things. It's a comprehensive, way of looking at things. So you could say capitalism, yeah, you could say it's a bird's eye view, but essentially it's a way of looking at things, okay? So it's like a socialist paradigm is different from the capitalist paradigm, because in the socialist paradigm, the government is going to own all the means of production, okay? There is no concept of private property. Okay, that's why in India, when Morarji Desai and all came to power, they had removed the right to property was a fundamental right under the Indian Constitution, but they removed that. Okay, after the emergency, when they came to power, the Janta government, they removed the right to property as a fundamental right. It is no longer a fundamental right; it's just a legal right. Okay, because they had a socialist orientation, so they felt that the fundamental right to property is a sin. So private property is frowned upon. So the point of a paradigm is that it covers many aspects. It's a way of looking at a system or looking at the world, and it has many aspects to it. Okay, so communism is a paradigm, communism or socialism, because it deals with many aspects of your life. Okay, so that's what paradigm means. So a forecasting paradigm, when we get into the discussion of models, okay, and predictive models, we will discuss the different paradigms once again in more detail. But the point is that fundamental analysis is a paradigm. Technical analysis is a different paradigm. Okay, just like capitalism is different from socialism, because on the important points like private property, in capitalism we give a special place to private property rights. In socialism we don't. Okay, so in that sense, technical analysis is a different paradigm from fundamental analysis. Okay. Does everybody know does everyone understand the difference between technical and fundamental? Okay, who's going to answer the difference between Nimish? Who's there at the back next to Keshav? Nimish, why don't you educate us on the difference between, give him the mic. Difference between fundamentals and technicals. So the info that we are giving you is that in TAM, the dominant forecasting paradigm. First, let's understand what is meant by dominant forecasting paradigm. So you understand that in any kind of money management, forecasting the market will be an important job.
Yes, sir.
Okay, that's an important problem to be solved. A decision problem, is this going to go up or go down? We discussed the decision problem of whether to buy or to sell. Remember? One decision problem if you're trading in, let's say trading in copper. One decision problem, basic decision problem you're going to have is, should I buy copper or should I sell copper? Okay, so that is actually connected to the forecasting aspect of it. So obviously if your forecast says that copper is going to go up, then you are going to sell. Okay, so no, I'm just testing you. I'm just testing whether you're sleeping or not. Okay,
We'll go long, sir. That is the long.
You'll go long. Okay, So 1 minute. So therefore, I'm just making a very obvious connection, but we still should highlight the obvious things. Why is forecasting related to decision problems? Because the decision problem that you face when you're trading in any market, like say copper, is that you don't know whether you should buy copper or sell copper, okay, to start out with, okay, as a starting position. So to do that, you need to get into this business of forecasting, because obviously you'll make a forecast about the copper market, and if your forecast is bullish, then you will buy, and if your forecast is bearish, then you will sell. So that's how forecasting is related to the decision problem, okay. So that's why we worry about forecasting. So what we are saying here on point number 8 is that in TAM, the dominant forecasting paradigm is FA. Okay, we are only going to say FA and TA now. We don't want to keep using these long words like fundamental analysis and technical analysis. But in AM, both of them are used. Okay, kind of almost you could say at least 60-40. FA 60% and 40% you could say TA. But here it's almost 100%, and no TAM manager would be caught dead admitting. They may actually use it, but they won't admit it. No TAM manager is going to be caught dead admitting that they use TA, okay? Because for them it's almost like a religion that we don't believe in TA, we only do FA. All right. So this is what is. So now you understand what we are saying when we talk about dominant forecasting paradigm. Okay, and I've used the word paradigm because FA is a comprehensive approach. It's a way of looking at things. When we do the distinction, the detailed analysis of FA versus TA, which we are going to do later on when we look at the decision problems in more detail. But right now, Nimish is going to educate us on the difference between FA and TA. Yes, go ahead. What? You don't know the difference between FA and TA? You tell us, we don't want to waste time. You're sitting there like, okay, then pass. Tanush will educate us. Who will educate us? Sahil will educate us. Okay. Let's give Sahil a chance. Then we'll go to Achal, and then Gaba. Okay, quiet, please. There's talking going on from this side. I don't want to hear any sounds. Okay, Satyam will lose points. Which group is Satyam in? Gaba. See, Gaba, you got to keep control over your people. Like Achal controls her own people, but she doesn't control herself. So Gaba has also opened his account. All right. Okay. All right. So, Sahil, yes, go ahead. FA versus TA.
Sir, FA that we analyze the balance sheet or market value of the company. So, all the fundamental analysis, all the theories we apply for calculating the actual value of the asset, that is fundamental analysis. But technical is
all the what? What do we apply? All the
theoretical or theoretical knowledge and the market knowledge to calculate the value of asset.
Okay.
So we actually come at the value of asset, then what should be the today's current market price of the asset, what should be the market price of the asset.
And what kind of inputs do you use?
So we can use balance sheet, profit and loss statement of the company.
Say all the past trends.
All the past.
Past trends also? Trends of what?
Sir, first
But not everybody together. Okay, then what's your TA?
So TA is analyzing the chart.
Dipanshu, keep track, make sure that not more than one person goes out at a time. Yeah.
So TA is analyzing charts, what is the trend of the share of the market, of the asset, whether it is bullish or bearish.
Okay. Don't say bearish. Bear. I know you like to drink, but don't say bearish. Say bearish. Okay. All right. Okay, Achal, what is Achal's reply? Let's have some. Quiet, please. Let's have some quick replies, and then we'll discuss it.
In technical analysis, we are not concerned about the past trends or what is the balance sheet. We are concerned about the price that is going on, current price that is there in the market of a stock. And in fundamental analysis, we see how the company has
still talking going on.
How a company has performed over the years and what's the industry trend and everything. But in technical analysis, we are just concerned about how the price is moving.
Okay, Gaba, you want to say something? You want to add something to that? To what they have said? Yes.
So fundamental analysis is related with the company's current past financial record.
Don't read from. Yeah.
The fundamental analysis are just related with the. It is the main evaluation of the company's intrinsic value of the securities, and then it is compared to the security value to determine which position we have to take. And then further we look at the past records or the future records and the.
How can you look at future records?
Through prediction models.
Prediction model.
Record is something which is recording some data. How can you look at future records?
Like
when you're standing today, you don't know what the future is.
Technical analysis is related with the price movement of the stock of the company.
Okay. Anyway, all right. So most of you have some idea. So Achal also explained it. But you made some. Some of you made. I think Achal you made a statement saying that we don't look at past trends. That's not true. The way to distinguish, we'll discuss it in great detail later on because there's a lot to the distinction between TA and FA. Okay. But the basic point in technical analysis is that first let's define TA. In TA, we are only concerned with market-related activity. Okay, any information generated by the market. So price action, volumes, you know that there's a concept of volume. Okay, you can figure out every day how many shares of so many of ITC traded today, right? Spoofing. Yeah, spoofing is
volume खेलना ही होता है सर HFT.
It
is also
high volume, buying stock at high volume.
No, what are you saying? You're saying so many things. Spoofing will not, 1 minute, let's understand. If spoofing is done successfully, it will not contribute to volume because volume is only traded volume. Okay, so if you and I, we are both on the NSE and you put in a buy order for 1,000 shares and I put in a sell order for 1,000 shares and the NSE matching engine combines us, okay, makes us meet and do a transaction, then the volume in ITC is recorded as 1,000 shares. Only when there is a trade. So if you remember what spoofing was, if spoofing is done successfully, he will remove the order before it gets hit. Remember?
Yes, sir.
You are placing false orders without any intention to execute, to scare people. So if spoofing is done successfully, then it will not contribute to volume. Okay. So the point in technical analysis, the point to understand is that technical analysis uses as focus on what the inputs are. Okay. Focus on what the inputs are for TA and FA. In TA, the inputs are all market generated information, market activity generated information, which means what is the price. Okay. Now we go back to treating this not as NAV plot, but treat it as a SPY price. So if I'm making a forecast on the SPI based on TA, I will look at all the things that are coming from market generated information. So what is the price? I'll look at the time series plot of the price. Okay. What is the volume? What is the open interest? In SPY you won't have open interest, but if it's a futures contract you'll have open interest. So all kinds of data that is generated by market activity, that is trading activity. Is everyone clear? This is the basic difference in input between TA and FA. In TA, this is our only input. We are not concerned with anything else. GDP, inflation, balance sheets, leverage ratio, this, that, nothing is of interest to us except for what is generated by market, trading activity in the market. Price, volume, open interest, etc. Okay, and any kind of calculations you can do. Here you can have all these kinds of indicators. These are, where are the indicators and strategies? Okay, so if I look at the S&P plot, I can have all kinds of, let's have any kind of, let's have a Chaikin oscillator. I don't know why it's not responding. Okay, we are not allowed to use it in the free version. Okay. Oh, sorry. It's because I don't normally use indicators. So we can see Chaikin oscillator. Okay. Chaikin oscillator is nothing but, we don't have to get worried about it. But this has been, the point is that this is calculated purely from the raw price data in the upper panel. Okay. So in TA, what you use, what you have to understand about TA is, you have to be clear about the inputs. The inputs can only be those in things which are that kind of information which is generated by trading activity in the market. So price, volume, open interest. And on top of that, you can do all kinds of manipulations by calculating technical indicators. But this Chaikin oscillator is a complicated calculation. But the point to understand is that the input for this calculation is only the data in the upper panel. So you can divide this data log of n period minus root of previous period, all kinds of stuff you can do. But the point to understand is that the raw data is coming from only the price figure in the upper panel. Is this clear? Okay, so in TA what we use is basic information generated by trading activity in the market and all kinds of permutations and combinations and calculations on that raw data. Okay, by calculating all kinds of indicators. There are literally thousands of indicators. Okay, and they're all based on they all have the same property, this that they're calculated from the basic high, low, open, close information that is coming from the market. Remember when we looked at charts, high, low, open, close? Remember all that? In each period you have high, low, open, close. Okay, open, high, low, close. If you looked at candlestick charts on your own, right? So you have open, high, low, close. So it's coming from that. By manipulating that information, you can come up with all kinds of complicated formulas which become your indicators. You just saw how many indicators exist, how many options exist on indicators. Okay, so I'm just going to remove that. So now everybody has a sense of TA. You understand what TA is all about? So understand the philosophical aspect of it also, that you are not concerned with anything that does not come from trading activity in the market. Okay, but the point that Achal made is not correct. She's saying that it's not based on past trends, but you do focus on past trends. So in technical analysis, you do, as long as your input is, you're clear about the input remains pure. The input is only information emanating from trading activity in the market. So on that information, you can do cross-sectional data, you can do time series data. So if you're doing time series data, then her statement is not correct, which is past trends of prices, and that's a very important factor actually in TA. So the past trends of the market, because sometimes you might look at different kinds of patterns. Okay, so if you look at, for instance, if you look at is this US oil, you will do different types of patterns. All right, so you might look at different types of patterns. So we do look at past prices. So this is historical oil data. You can see the volatility. So you might actually look at some kind of patterns like inverted head and shoulders. You might say these are like two different heads, and this is the neckline. Okay, and this is these are the two shoulders. This is the head. I'm just giving you a flavor of it. We are not really trying to understand this pattern. I'm just giving a flavor of what people do when they're doing TA. They look for patterns. They say that, okay, this is a head. This is the inverted head and shoulders. This is the head. This is the left shoulder, right shoulder. There's a neckline, and the price is broken out from the neckline, and therefore it's going to go up. So this kind of stuff is done in TA. Okay. Now FA is all about. So everyone is clear about TA now. Okay. FA is all about fundamentals. So let's look at the stock screener to give you an idea. Okay. So fundamentals means these terms are actually not very good. Okay. Because fundamentals doesn't tell you anything about what fundamental. I can say that market price data is also fundamental. So this fundamental is not very illustrative, this term. Just like technical is not illustrative. Okay. Today we know that, okay, now that I've explained to you, you know that if you go to some company and people are talking about technical analysis, you know what it means. But if you look at it on the face of it, this term is not illustrative. What do you mean by technical? I can say all kind of stuff is technical. Okay, so therefore these terms are not illustrative, but this is what people use in the industry. Okay, so we need to be familiar with these terms. But in fundamentals, what we use in FA is, here again you have to focus on the inputs. What are the inputs? The inputs are essentially all kinds of macro and microeconomic data. And in microeconomic data, I am including even company specific data. That is all the financial statements, everything. Okay, so I'm stretching the definition of microeconomic data, but it is actually part of microeconomic data, because when you do microeconomics, you do your average cost, firm marginal cost, all these things. That's a firm level data. So in microeconomics, the concept of firm level data is included. So the short way to remember the inputs of FA is all types of macro and microeconomic data, including, you will also bring in elements of geopolitical analysis, like this whole business of the Iran oil sanctions, when people were thinking about the Iran oil sanctions and what it will do to the supply of oil. Now what's going on, which country is facing a lot of political, which major player in the oil market, major producer of oil is facing tremendous unrest? Venezuela. Good. You're making me feel a lot better today, because people are at least plugged in. Okay, so Venezuela, remember that Venezuela has has higher proven oil reserves than Saudi Arabia.
Yes.
Okay, and today they are in absolute turmoil. People are like eating dogs. There's no food in the supermarkets. There's like a lot of, now there might be another coup or something because there's a political tussle going on between Maduro and the new guy, Guaido or somebody. So there's a lot of problems. So Venezuela, so all this analysis that you do, okay, like what's going to happen if you're an oil analyst? You have to be concerned with what's going on in Venezuela because their oil output used to be 3 million barrels per day, but because of all these problems over the last 4-5 years, it's now come down to actually below 1 million barrels per day. So if that even 1 million barrels disappears from the oil market, what will be the impact on the price? When you're doing all this analysis, okay, this will also be categorized, for want of a better term, under FA. Okay, so all geopolitical factors will also come under FA. Okay, although mainly when we think about FA, we think about macro and microeconomic factors.
The price will increase.
Yeah, ceteris paribus, price will increase. Okay, but you have to look at all the other actors because US shale output is increasing dramatically. The US is now pumping more than 10 million barrels per day. The US is the biggest oil producer in the world by a wide margin now.
Yes.
Okay, so the US shale oil output is a big factor in the oil market. Okay, so it can go both ways. You know, it can shrink because of all kinds of problems. Okay, so that is what you do in FA, macroeconomic and microeconomic analysis. I'll just show you briefly how to use the stock screener if you want to play around. Those of you who are, you can do a lot of testing on this. Here, see, they already have indicators. You can play around with this. You go to fundamental. You can do all this kind of stuff if you're doing value investing. Should I forward PE? Are you following what's going on here?
Yeah.
So if I'm a value investor, let's do a check on value investing. Many of you messed this question up also in the answer in the last exam. I explained to you the difference between Howard Marks and Warren Buffett as investors. Okay, or maybe the question was as value investor. I think I left out the value investing part. But the point is, you will not typically hear of Howard Marks being spoken of as a value investor, because typically when the industry talks about value investing, they focus on equities, and Howard Marks is focused on debt. Okay, but you have to understand the fundamental approach in value investing is it's a mean reversion or momentum approach. Mean reversion. Okay, so value investing, the fundamental approach in value investing is we wait for a market panic. Okay, so that the market can actually ends up selling. In that panic, the market ends up selling a particular asset down so sharply that the market price of the asset is far below its fair value. That interesting term that he used, which is correct, that's good that you're using the term intrinsic value, which is what Sahil was also getting at, but you didn't use that term, fair value or intrinsic value. Okay, so there is a fair value or intrinsic value, let's say at $100. And in a market panic, people have sold down the asset price to maybe $30. So that's when the value investor is going to sweep to jump in. The value investor is going to jump in and buy that stock in the expectation that there will be mean reversion. It will flow back to the asset. The asset price will move back to the fair value of the asset. Is this clear? So if you understand value investing from this kind of fundamental theoretical perspective, you will then understand that Howard Marks is doing exactly the same thing, but he's operating in a different asset class, in debt, and in particular in distressed debt, but so in company specific debt, etc., and sometimes sovereign debt. So yeah. Okay. All right. So is everyone clear about this now? Difference between, many of you got this question wrong in the exams. Difference between Howard Marks and Warren Buffett as investors is both are value investors. So you should have explained what is value investing in these general terms, that it's a species of a mean reversion strategy. Value investing is a species of mean reversion strategy. Do you understand this sentence?
Yes, sir.
You understand the way I'm using the word, the language, Ayushi? Value investing is a species of mean reversion strategy. Is everyone able to follow?
Yes.
Now Ayushi, give me a similar statement from what you learnt in lab in your law course. By similar statement, I mean that if I say that Bhupesh lives in Dwarka, you make a similar statement and say that Gaba lives in Rohini. So in this similar way, if I'm making a statement that value investing is a species of mean reversion strategy, right? Go back to your law course. Everybody listen to this because I'll ask other people. and make a similar. Is everyone understood? Is my question clear?
Yes.
I am saying that value investing is a species of mean reversion strategy. Now go back to your law course and make me a similar statement from your law learning. What is a species of what? Pass the mic to Shivam. All contracts are agreements. So, but you're not using the word species. I want you to use the word species. Value investing is a species of mean reversion strategy. So you have to, whatever sentence you utter, you have to use the word species. Quiet. Yes. Okay, we'll go to Shivam. Yes.
Agreement is a species of contract.
Agreement is a species of contract. Okay. Anybody else? Any other input?
So Sales of Goods Act is a species of
Indian contract.
Okay, Sales of Goods Act is. Anybody else with any other input? I saw lots of people murmuring here. AA2, you want to say something? My question is clear. I think the question is clear from the type of answers I'm getting. That whatever you say from your law learning, you have to say it in this structure. X is a species of Y. Okay? So, anybody else wants to contribute?
Debt is a species of asset.
Debt is a species of asset. That statement is correct. But it's not coming from law. I want to get something from law. I want you to tell me something about what you learned in law. Nobody? Anybody else? No one is able to tell us? Nene, 1 minute. I want to get this answer from the class.
Contract is a species of agreement.
Correct. So finally Shivam has zoomed in on. He had parked his car the wrong way. But now he has zoomed in on the right answer. That contract is a species of agreement. This is the answer I was looking for. Okay, your answer is also correct, but it doesn't come from law. That's why I focused you on law. So if I say contract is a species of agreement, then which is a smaller, which set has fewer elements in it? Contracts or agreements? Listen to my question. Contracts has few. What is my question? If I say that contract is a species of agreement, then which set has fewer elements in it? Contracts. Okay, so now you understand? Okay, good. But I'm surprised to see that nobody was able to tell me from law what we studied, because we discussed this point many times. Okay? No, that is total rubbish. No, that is not correct. Total. I don't want to denigrate what you're saying, but that was totally, that was not correct. Okay, I shouldn't have used the word rubbish. I don't want to discourage you. You are welcome to say anything in the class, but that is totally wrong. That is not correct. Okay? Alright, okay, guys, now. Okay, guys, please. So you understand what I mean by saying that value investing is a species of mean reversion strategy? Because there can be many, I can show you mean reversion strategies in TA. Okay? So that will share some common property with value investing, because value investing is a FA approach or TA approach? FA. Okay? So value investing is only fundamentals. They will only look at these kind of factors. Okay? So in value, so I can show you a TA approach using oscillators, which is a mean reversion approach. So that there is a common property between that and value investing, because both are mean reversion approaches. Sorry? Donchian 4-week rule is Donchian 4-week rule. 1 minute. Yes.
That is a TA.
TA. So the Donchian 4-week rule, which we also covered, belongs to TA, and it's a momentum strategy. Okay? Not a mean reversion strategy. Okay, guys, please pay attention, including Lakshay, not to your mobile phone. Look at this. Okay. All right. Okay. So when you're doing value invest, to give you a flavor of FA, most of FA is either macroeconomic analysis, which we don't have here, but macroeconomic. Let me test once again value investing. Okay. So if I'm a value investor and I'm using this as a filter, so should I go for high values or low values? I'm using, you understand what stock screener, you understand what a stock screener is?
Yes.
It's a filtering technique. Okay, just like a company comes to the campus and says, we are so hot that we are only going to interview people who have a, average grade of, A- and above. Okay, so that's a filter. I'm just saying, I'm just giving an example. They're applying a filter. They're saying, we don't want to look at all the students, I want to look at only A- and above. Okay, I'm just saying it's a filter. So similarly, this is a stock screener. It gives you an opportunity to filter. Okay, it's a data manipulation software. Okay, there is a database in which there's lots information on lots of companies on different aspects, and this gives you a way to query the database and give out reports. Okay, so you can set multiple filters. So if I'm a value investor and I am filtering companies based on forward PE, what is PE? Okay, good. So forward, if I'm doing, so should I select low values or high values?
Low.
Sir, in case of value.
Yeah, I'm saying that I'm a value investor. Nikita, should I select low values or high values? Low values? Okay. All right. So then I'll go, let's say, under 5. Okay. And what does it do? It immediately gives me 93. Earlier, if you had seen, there would be higher number of stocks. Now, by applying a forward PE below, what did we choose? 5? Forward PE below 5 means immediately the total number of stocks that was shown to me now has been cut down to 93. Okay, so only 93 stocks pass this filter. That only 93 stocks have a forward PE less than 5. Is this clear?
PE ratio, we should use PEG ratio.
That's okay. I'm just giving an example. You can use PEG also. Okay. But PEG is not very commonly used. PEG is not very commonly used in the market. More common is forward PE and sometimes just current PE. Okay. But forward PE is the most common. Okay. Forward PE is the most common. So anyway, so this is an example. You guys can play around with this. Okay. I'll just add. I think this is already in your sheet. But I'll just add it to your, all right, so this is one filter. Okay, so now you can keep on adding other filters and keep on reducing the number of stocks. Okay, if you want to build a portfolio with only 30 stocks, you can keep applying filters until the number reduces. All right, so if I use sales growth past 5 years, if I use over 5%, let's say, then it'll go down from 93 to 35. Can you see that? Are you guys seeing that? Okay. So now this gives me there are only 35 stocks which have forward PE below 5 and plus they have sales growth over the past 5 years over 5%. Okay, so that's how you use this stuff. Okay, so I've given you the link. Please play around with it. Okay, so this is your brief introduction to FA and TA. This is a very big topic, so we can do this. We are going to do this in greater detail later on. But if we come back to TAM versus AM. So the point number 8 is that the dominant forecasting paradigm in TA is only FA, in TAM is only FA, and the other one is both FA and TA. Okay, so that finishes this particular topic. Okay, why is there noise coming? Is it?
So we have a 2.5 minutes.
Yes, sir.
2.5 minutes. Okay, we'll see. This is actually the lunch break.
Yes, sir.
Okay. Then I can give you a little bit of a leeway. 1 minute. But we still have time. 1 minute. 1 minute. Okay, guys. Now one more thing. Let's give some instructions at least. Nikhil. Okay. So Nikhil also should lose -2 because it's in the middle. No. It is still part of the class has not been discussed. Sorry, the class has not been. I said discussed. The class has not been dismissed. Where is Nikhil? Kriti. Yeah, this is just to make sure that people don't talk until the class is dismissed. Okay, guys, we have to do a project on TWS once again. So please make sure, I hope I sent you that message earlier. I make sure that your 3 IDs, one ID should remain pure, no trading in that ID, but make sure that that ID also works. Okay, so just see if the feed is coming properly. You can go up to the point of transmitting the order, because when that error message comes, the error message comes out saying you don't have real-time data for this order. That's what we don't want to see. So take any kind of contract, just enter the data for Facebook during US trading hours, wait till US trading hours 8 p.m. Okay, then otherwise if you open up the oil futures contract, okay, or copper futures or something, and then test it during any time you want, gold futures, okay, and make sure you try to do a trade. Don't actually do the trade in the account which has to be protected, okay, for your actual project trading. but go up to the last point of transmitting, just before transmitting, okay, the order. Then before that itself, you'll get the message. If there's a problem with the account, you'll get the message saying you're about to enter a trade in a market where you don't have live data. Okay, you get that warning message. Make sure you don't get that message. Keep all the 3 accounts active. Just get in every day, and in the practice accounts, go in every day and do some bang, buy, sell, whatever you want to do. Okay, keep it active. Make sure you do some trades. Okay, so and keep them active, and then we'll talk about the project as such. So how many people have not done that? Have not done this? How many people have not tested this? All groups have tested? What? I'm not getting a response either way.
Yes, sir.
All groups have tested?
Yes, sir.
So why have you not done it? So make sure, 1 minute. Okay, guys, let's get this. I understand it's still not time for lunch. Okay, just wait, guys. 1 minute. Let's get this instruction very clear. All teams must do what I've just mentioned. Is this clear? All 3 accounts given to you. Make sure tomorrow I want a full report. Okay, make sure that all accounts are working. Try to do a trade in the actual project trading account. Don't press that transmit. In the other 2 practice account, you can trade as many times as you want. Make sure you don't get any message saying try out US tickers like Facebook, Twitter, etc. and try to trade during US trading hours. You need those US equity because this is a US equity option trading project. Make sure enter tickers like AMZN, Amazon, Facebook, Twitter, and try to do trades in your practice account. Okay, is this clear? All right. So tomorrow I want a full progress report from all the groups. Is this clear? That all 3 accounts that you have in your group, you should give me a progress report on that. Okay, because then based on that I need to go back to the broker. All right. So okay. All right. Okay. Class dismissed. So I still owe you 15 seconds.
Yes, sir.